We've got the easy job, how you position portfolios to make your clients very wealthy and potentially yourselves, if only. I've written in the last year that I think this is the most challenging environment from a portfolio construction, asset allocation perspective in the 30 years that I've been involved in the investment industry. Obviously we've got interest rates still near record lows. The chase for yield and return means that it's very hard to find cheap assets. Debt levels effectively above where they were prior to the GFC. Central banks have become the big driver, and we've got the path to normalisation and the uncertain impacts that will have. Obviously, we've had significant and potentially growing geopolitical risks. We've got a reality TV star running the most important country in the world, who seems to not be able to stop telling people they're fired, albeit in the case of North Korea's Kim Jong, he might say, "You're fried." Bit early in the morning for that one, I think. There's also been talk of this passive bubble, and it's interesting that our two panellists sort of both use passive vehicles, but in an active way. And I think the jury's out on whether there is a passive bubble, but we may touch on it. But I think there is somewhat of a bubble in the number of valuation insensitive investors that are participating in markets these days. It's not just ETFs and index funds, but trend following is bigger than it's ever been. Some of the factor-based investing is not sort of fundamental based. A lot of sort of robo-advice, SAA-driven buy and hold investing. The best strategy, obviously, in recent times, has been just to buy the dips, but even that seems to be sort of failing. This year, the biggest dip in the S&P 500 has been less than 3%. So as that strategy has been taken on by the quants, it's even sort of undermining that. Fortunately, our panelists do look at fundamentals and valuation, and they'll talk a bit more about their approach. I'm not going to go through their bios. I think our session's already down to 25 minutes. But John Riley, CIO of Implemented Portfolios, and David Bassanese, Chief Economist of BShares, was going to start up with a few slides talking about their approach and their views, particularly current views on the world. And then we'll sort of delve into some more questions specifically around implementing these approaches through managed accounts. And finally, just speaking of the US President, I was talking to the Donald over the weekend, and he assured me that he's given me the power to pardon our panellists if their forecasts turn out to be total rubbish. So first to John.
Thanks, Dominic. One of the things I learned early was the art of forecasting is to give a level or a time frame, but never both. I'm going to break that rule here. Look, this approach we use to predicting investment returns is not unique to us. I do have the benefit of having three wise men with me on my investment committee that bring extensive experience in markets, but essentially when we're looking at what we expect an asset class to return over the long term, we're focused on just three things. As an investor in that asset class, how much income am I going to get? How quickly is that income likely to grow? And then how much are people likely to pay to access that income stream in the future? So for us, if we frame this in terms of an equities asset class, we're obviously looking at dividends there as the income stream. As an Australian investor, the grossed up dividends is what's important to us because that's what the end investor receives. The middle piece there in terms of how quickly the income is going to grow is obviously fairly strongly correlated with how quickly earnings are going to grow for that asset class. So on the next slide, we're going to look at a couple of different ways of forecasting that. And then finally, it's changes in sentiment. So any of the valuation multiples are going to give you a read on where things are relative to where they've been historically, and whether you can form a view now on whether they're cheap or expensive. The one we tend to focus on and publish is a price to earnings ratio. So we know what that one is. We can look that up in the paper or on our screens. As an investment committee, we spend our time developing forecasts around the last two of those. How quickly are earnings going to grow and what are people going to pay to access them? Now within that, there's those three can be split in terms of what's fundamental and what's sentiment. The first two are obviously the fundamental aspects, and over long periods of time is what drives your eventual return. The last being changes in valuation multiples is obviously a sentiment indicator and can change significantly in much shorter periods of time. So we do look at a long-term asset class forecast. For us, that's a 10-year period, because over that length of time, you do see those fundamentals assert themselves in terms of your investment return, rather than the much noisier and shorter-term changes that you can see in valuations. Two different ways of thinking about that. One we've used in the past is a basic GDP diluted method. So if you think about nominal GDP, these numbers are somewhat stylised. You'll see in the second half as to how I've got them to come out the same. But, you know, real GDP at 3, inflation at 3, you know, that might be more like 3.5 and 2.5 if you want to be consistent with the RBA band at the moment. But we can observe empirically over really long data sets and across a range of countries that you get a dilutionary factor from that nominal GDP. And empirically, it makes sense that you're not going to see companies grow their earnings faster than nominal GDP growth forever. There are obviously other sectors of the economy which contribute to overall growth. But in this case, nominal GDP of 6, an empirical observation there across those range of markets and timeframes gets you to about a 2% dilutionary factor, and you can get an assumption for core earnings per share growth of around 4%. What we've found has been a more effective means of forecasting earnings growth in the last sort of 5 to 10 years or so has been basing the starting point on valuations. So that first GDP diluted method works when you've got economies growing at or around trend levels. But what we've looked at is a number of examples where economies are either growing particularly strongly or more prevalent examples recently has been where economic growth is slow. The key metric there that we're focusing on is the per share metric though. It's the EPS. So when we see countries, economies, sectors, regions growing very strongly, it's because, or it's often accompanied with strong capital issuance which dilutes your per share metric. So starting with this valuation-based methodology gives us a better outcome we've found in situations where economic growth is not around those trend levels. So if we assume here a PE ratio of 16, we invert that to get an earnings yield of 6.2%. These are some of the sort of quantitative driven but qualitative final estimates that we make here. What's the dividend payout ratio? So in the Australian example here, or not necessarily an Australian example, Australia often obviously pays out a higher payout ratio. In this example, we've assumed a dividend payout ratio of 50%, so your earnings yield is knocked down by half. We have a wastage factor in there, or an inefficient investment factor. We know the decisions that collectively are made aren't always good ones. Might be overpaying on M&A transactions, that sort of thing. But equally, there's some balance sheets on the asset that are likely to grow with inflation over time as well. So those sorts of assumptions need to be modified for the country or the sector that you're forecasting. But overall, you can get to a similar sort of scenario where you see core earnings per share growth around that sort of 4% number. We do incorporate a second element into our earnings numbers there, which is where do we sit relative to trend. So core plus return to trend. We know there's strong cyclicality in the earnings cycle, earnings markets over time. So if we're ahead of trend, we expect to give some of that back. If we're below trend, we expect a catch-up number there. So we've got our income and our earnings growth assessments there. And the valuation multiples tend to be similarly a long-term mean reversion story there as well. I know David's going to talk a little bit about how they consider valuation multiples there. For us, we see in a lot of markets around the world and over a lot of time frames, low interest rate, low inflationary environments tend to coincide with high valuation multiples. Higher interest rate, higher inflationary environments tend to correlate with lower valuation multiples. So we think we can get a reasonable long-term read on where they sit. And lastly, I'm not going to certainly run through any of those numbers, but you can see on the right-hand column there, we still think the outlook for Australia looks pretty good. In international markets, kind of a tale of two halves there. US outlook looks pretty ordinary for us and has done for some time, but we are encouraged about the turnaround story in Europe and still think there's good prospective returns out of Japan as well.
Okay, we'll pass over to David now. Hoping to have time for audience questions, but
Is that working?
see how we go.
On? Yep. Great, thank you. Yeah, so I guess my role at Beta Shares, as in the chief economist roles, we do like global we have a number of funds, but my research is basically focused on those big asset classes that are the building blocks for most standard model portfolios. So our first approach, well, at least my approach, is to focus on the 6 main asset classes, and have like a long run sense of what valuations are for those key 6 asset classes. And I've just got some of the assumptions up there in the thinking. So start off with cash. Long run neutral rate for the RBA. In fact, I put this together about 6 months or so ago, and now the RBA has just come out and officially confirmed that their neutral rate is 3.5%. So I'm sort of pleased about that. But a rough rule of thumb is that your return on cash will be sort of broadly close to the RBA neutral rate of 3.5%. Bonds, the asset class there, typically you go 50-50 Australia and international. Australian long-run bonds trade at a premium to cash. 3.5 neutral rate gives you a 4% 10-year bond yield for Australia. Internationally, they tend to be a little bit less than the US 10-year bond yield. So you take a weighted average, you end up something like 3.5% as a reasonable long-run return for bonds as an asset class. I won't go through it in detail there, but listed property, it's a lower volatility asset class than say equities in general, so the return there is a little bit less than Australian equities, something around about 9%. I don't disagree, in terms of the earnings growth there, we've got the same number, 4%, grossed up dividend around 5%. International equities a little bit lower, and commodities. So basically that's your starting point in terms of SAA, so if you're putting together an SAA model, you can plug in those numbers. Historically, we've got a good sense of what volatility is by asset classes and correlations, and you can come up with a set of model portfolios. Now then the issue is, in terms of, again, a lot of the work I do is, what's happening around the edges, what's the tactical asset allocation around that. For example, bonds, maybe the long run is 3.5%. Historically, it's been a lot higher than that over the past a decade or so because bond yields have basically been falling. And so the worst thing you could do is basically look historically at what these asset classes have done and make an assumption that that will be repeated. And so in the case of fixed income, that would be one of the worst assumptions you could make. So how do then we approach? Basically, the way I do it is it's a hierarchical approach, and it's basically a set of pairwise comparisons. So from a tactical point of view, the first key question to me is growth versus defensive assets. If you go back to here, the defensive assets there are cash and bonds. Everything else can be described as a growth asset. So again, it's the 80-20 rule in a way. I think if you can get that key decision, should I be overweight growth assets or not at this stage of the cycle, is going to get you, 80% of whatever alpha you could hope to achieve from tactical asset allocation. And but then within that you go within defensive, well, cash versus bonds, what do I like? And then within growth, Australia versus international, property versus Australia, and then commodities. So a set of sort of pairwise comparisons, and then look at the key underlying drivers of those decisions. So what are the key variables that will drive a decision to be overweight cash versus bonds or Australia versus international? And again, I guess the approach here is a sort of what I may misquote him, but Maynard Keynes said, "I'd rather be broadly correct than precisely wrong." I think if you get the big picture sort of broad trends correct, that's really, I think, the most you can hope for in a practical sense. So just going through that, equity risk premium. Growth versus defensive, you look at the sort of PE ratio versus bond yields and look at for those major mispricings. When coming out of the GFC late 2008, the PE ratio very, very low, relative to bond yields, and so equities are very expensive. You go back to the dot-com bubble, equities are very cheap, and the dot-com bubble, equities are very expensive. So look at that equity risk premium, bonds versus the PE ratio, and basically, are you at extremes? If you are, then you weight accordingly. If you're in a sort of broad fair value range, you can't take a big call. At the moment, basically, PE ratios are above average, but interest rates are below average. So if you actually look at the equity risk premium, it's sort of broadly in line with its long run trend. So at the moment, I'd be neutral as a broad position on growth assets versus versus defensive assets. I'm not underweight equities, but I'd be, whatever your SAA is in terms of equities, I'd sort of be close to that in terms of positioning. Cash versus bonds, again, the key driver there is bond yields. So if you think bond yields are going up, you've got to be underweight bonds. It's simple as that. And basically, you may not get the next month-to-month call right, but I think over looking at it over a 1 to 3 year period, I think bond yields are unusually low and they're going to be rising. So over that sort of time frame, you want to be underweight bonds. Then going through it, property. Again, property is another one where you can basically reduce that call down to bond yields. If you look at the relative performance of property to equities, it's driven by bond yields. And property's done very well in the period where bond yields are rallying. If you think over the next few years, bond yields will be selling off. Your tactical view would be to be underweight property. International, what are the key drivers? Aussie dollar. If you look at the key asset class here is the unhedged Australian dollar value of international equities. And if you look at the performance of international equities unhedged versus Aussie, key driver is the currency. If you get your currency right, you're halfway there to achieving outperformance in terms of that tactical allocation. And at the moment, where's the Aussie? I think it's too high. I think it's going to be falling. My view over the next 1 to 3 years would be a target of something like 65 cents on the Aussie. So that would drive me to be overweight international versus Australia. The other thing to look at is sector trends. So we had that big commodity boom, which led to a really strong outperformance of Australian earnings. So basically, if you're overweight resources, you think resources are doing well, you'd be overweight Australia. What we see now, the mining boom is over. The global demand is shifting toward technology, and so corporate earnings in Australia are underperforming what's happening internationally. So that is another factor that would suggest underweight Australia and overweight international, because the composition of growth globally is shifting toward areas that we're not particularly favoured at. You look at the Amazons and the Googles and whatnot are the really starting to eat into the business models of our more traditional players. And then commodities as well. Our price is really relatively high or low in real terms, and what's the supply-demand balance? So you look at most commodities at the moment, you say most markets are pretty well supplied. Oil, agriculture, inflation's pretty low, so my core view would be to be underweight commodities in that environment. So again, it's not precise. I'm not looking at, I'm not trying to precisely forecast the particular returns on these things on a 1 year, 5 year, 10 year view, but it's more a 1 to 3 year medium term view of where the trends are for the key underlying drivers of these asset classes, and then to see broadly positioned accordingly relative to an SAA. The other element in terms of tactical, just quickly, is the other things you can do, of course. So I've only talked about the 6 asset classes, but then you've got so-called intra-asset class tilts, where you may look at international equities and say, okay, are there opportunities to sort of, go into Europe or go into Japan versus the United States, or even sector trends? And again, whether we get into it or not, one of the beauties of exchange-traded funds these days is you can easily take sector calls in terms of Australian and global markets with one investment. So at the moment, you can get into technology through the Nasdaq. Global banks, I think, are very favoured in a rising bond yield environment, and they're exposures you can get to global banks as well, and also floating rate bonds. Another one to think about in fixed income. If you need to have a fixed income allocation, but you think interest rates are rising, so the return on a fixed income exposure is going to be particularly poor, there are now options to invest in floating rate bonds, again through the ASX. And the beauty of that is as interest rates rise, the income from those bonds rises as well, and you're not as negatively affected on the capital side. So lots of different opportunities, and that's really the sort of way in which I approach things. And happy to.
I might just follow up on that currency issue. I mean, the Aussie dollar's obviously had a very strong run in the last week or two. And in terms of, it has a big impact on returns, and particularly in the context of the managed account structure and incorporating sort of currency views and risk management given that they often can't explicitly hedge. How do you deal with that? Perhaps John first.
Yeah, sure. In all of our international equities forecasts, we do include a currency impact in there. It's not so much a short-term currency forecast as more so that we're trying to allow for the impact over our long-term period there. So we're simply just making an assessment between the long-term bond rate differentials between the relevant exchanges. The other point I would make is we talk about the strength in the Australian dollar, and we're all accustomed to talking about that against the US dollar, which has really driven all of the other exchange rates around the world for certainly the last 6 months since Donald Trump came to power. When we look through, and certainly in our exchange-traded fund portfolios, the currency exposure that we're concerned with is to the basket of companies that we own, whether that's Europe or Japan, or emerging markets or whatever it might be. So $8 basis against those hasn't been anywhere near as strong in most recent times against those other exchanges. And what we've seen is actually US dollar come back to earth following it going on a tear post the election.
Mm-hmm.
Well, I mean, I guess I go back to, the traditional asset class when you're looking at model portfolios is unhedged international equities. So, obviously currency plays a big role in getting that, that overall view right. I mean, so, and again, so to my mind, the currency call is critical, and it's like probably the single most important thing in making that decision. Now, if you don't want to worry about currencies and you want to just get, you can get hedged exposures to international equities as well. And again, listed, unlisted, there's a number of options out there. But Mike, the Beta Shares group here will rib me a little bit because I've been calling a weak Aussie dollar for a while. And it's just refused to go down. It's been trapped in this range, and everyone's saying, I've always been asked, well, we'll eventually break that range, and it's going to break it to the downside. So, I've been calling 72 cents by year end, at 65 cents eventually. So it's pushed up to the top end of the range. And again, I'm even more confident today that the Aussie dollar will eventually fall, given, if it's around 78, 79 cents, then it being around 73 cents. I mean, the third currencies are another issue as well. But again, bigger picture, it's the trend versus the US dollar is more or less, more or less indicative of the broad trend in the Aussie.
One of the things that comes out of the presentations is the focus on longer term valuation, which makes total sense. Valuation often doesn't help much in the shorter term, but that driver long term. And the current environment where, because bonds and cash are so low, there's a big relative argument to be at least neutral, but perhaps overweight growth assets. But that suggests that we could have periods where the path of returns, even to longer term sort of return forecasts, is more vulnerable or volatile on the downside, particularly when you don't have the protection of high starting yields. I mean, what can you do in building portfolios in the managed account structure particularly to sort of perhaps improve that path or smooth that path of returns?
Well, if we focus on Australian equities where we do have an overweight and we're reasonably optimistic about the outlook, 6 to 7% grossed up dividends is a pretty good basis for your overall expected return. So you don't need demanding assumptions at all in terms of earnings or valuations to get to your 8 or 9 or 10% number. So we take a bit of comfort out of that.
Hi. Yeah. Well, I guess it just goes back to asset allocation. Look, there's, there are downside risks to equities at the moment, but I mean, from an overall valuation point of view, I think things are pretty fair. The global economy is improving, inflation remains low, so central banks are going to be very cautious in withdrawing, withdraw the punch bowl, so to speak. So, if markets pull back 10, 15, even 15%, that's still consistent with like a bull market. You get basically getting a cyclical correction within a bull market. And I think, end of the day, you've got to fall back on your asset allocation. If you're worried about markets falling in the short run, you don't have the correct asset allocation, or your clients don't have the correct asset allocation. So, A, it's asset allocation, it's B, it's time frame. If you can take an appropriately, medium term, at least 1 to 3 year, even in the short, if you're trying to micromanage a 6-month market, you're going to get it wrong. You just got to have a longer term sense of where valuations are, you know, where bond yields are eventually going to be gravitating toward over the next few years, and sort of be positioned for that rather than trying to micromanage what may happen over the next 3 to 6 months. And if you're worried about the next 3 to 6 months, make sure your asset allocation is right and try to change your time frame, because you're just going to give yourself a lot of grief that could, you know, you're not going to avoid problems if you're trying to focus on those sort of time frames.
Okay, I've got a couple more, but if we've got any from the audience, should try and... Was that one question or 1 minute? One question we've got time for. I can't see it. Well, I might just ask, you know, perhaps John more so, you know, what are the main constraints of the managed funds, the managed account structure in terms of implementing portfolios? I mean, what precludes you doing things from an investment perspective that you prefer to be able to do that are either difficult or impossible in the managed account structure?
Look, for us, the focus is on getting that long-term asset allocation decision right. So in most of what we manage, we're then just trying to make the simplest, or build the simplest portfolio to capture those exposures. You know, what I often talk about for us, our dynamic asset allocation is about leaning towards the things which you think are going to do well and away from the things that are likely to do poorly. For us, one of those key things is in a risky asset class or sector or country, if the outlooks look lousy for us, then we're happy to go to zero. So that's something that, you know, we think is an advantage of the managed account structure. In terms of the individuality of it, our experience has been with advisors who don't want to dedicate their time to micromanaging portfolio issues or security selection issues. They want to do the relationship sort of piece and grow their business that way, that we heard through the first session. So working with those types of advisors who don't want to get particularly nitty-gritty and exotic with some of the sorts of things that they want in their portfolio really precludes a lot of that, you know, the sorts of issues that you might otherwise get into if you were to get particularly specialised around, you know, tailoring individual portfolios. So outside of that, you know, it's a really sort of broad structure in which you can adopt your own asset allocation and security selection stance. We do run a version of our portfolios where we partner with a stockbroker to give us direct equities portfolios that we can then plug into our asset allocation views. So we do try and be very inclusive in not forcing our methodology and structure and process onto the advisors, but accommodating them and partnering with them to deliver it.
David, not sure if you've got any comments in terms of your interaction.
Yeah, look, I guess the main thing I would sort of, I try to promote, and I would urge people to do, and again with the beauty of managed accounts and you know, in our case exchange traded funds that do allow you to easily represent a whole asset class in a single instrument, is not overly complicate things if you can. I go back to the 80-20 rule. You know, focus on the key 20% of things that are going to generate 80% of your performance, and just make sure you're, you know, broadly correct and not precisely wrong. That's basically all I would say.
Okay, I think our time's up. Please join me in thanking John and Duncan.